It's interesting. I think when people invest, they like to expect that they'll get 100% of their decisions correct. And everyone that's been investing for any amount of time knows that's a complete fallacy, that you'll never get close to all your decisions right. In fact, you're probably only going to get, if you're great investors, sort of 40 to 50 to 60% of your decisions right. So if you go into it with that view, then you need to know that to be a good investor over the long term, you've got to make some hard decisions, that you've got to admit when you're wrong and deal with it appropriately. And I think that's when you're in a sort of professional job like myself and you're doing it every day, it becomes easier than if you're a private investor and it's just a bit of a side hobby. And so I think we make some of our best decisions in terms of cutting positions that start to go wrong, and we cut them when they're little problems and before they become big problems. And I think that's something I'd really implore private investors to think about, is when they see an investment not performing to their expectations, rather than take that bottom drawer, I'll just put it away and wait for it to get better, is to just make the hard decisions. Cut that position, take it a capital loss, and have that cathartic experience where you can stop worrying about things that are going badly and recycle that capital into businesses that are going well. One of the beauties of long-term investing is that the most you can lose is 100%, but the most you can gain is theoretically unlimited. So if you have this decision, this view in investing, which we do, is that you can let your good investments run and make you a lot of money over a long period of time. And when businesses start to go poorly, you cut them off and recycle that capital into businesses that are going well, then I think that's a really, really good balancing technique that means your overall portfolio will perform very strongly over time. The most recent example, and it's very high profile, has been the complete demise of Blue Sky Alternative Investments out of Brisbane. That was a business that we'd been in for quite a while, and it had performed quite well, but it was trading at record highs late last year, around $14 a share. And as people that read the press would well and truly know, there was some undertones that business wasn't travelling well. There were some negative reports around, and there was the start of some reputational damage happening. Now, it's taken about 4 months for that whole business to unwind and the shares to be really decimated. But when we saw the start of that happening, we thought that would be something that could get worse and not better. And rather than take the philosophy of, look, let's just cross our fingers and kind of hope it gets better, we'll take some immediate decision. And we lost a lot of money over a couple of weeks in that business, and we were never going to make that money back by selling that stock. But certainly looking back, it's fallen another 70 or 80% since we made that first decision to sell. So sometimes, the first mistake you make is the best mistake to make, rather than holding on and making more and more mistakes in business. And I think that's something that we're really grateful we made that right decision.